the franchise, another criteria is the franchisor is not obligated to return or in any way to refund the cash already received. So class, as you can see now, this is an end condition. So both conditions should be present so that we can say that it is the services are already substantially performed by the franchisor. Okay. So what's the significance of the substantially performed criteria condition? Because as I summarized in this diagram, so we should the recording of the revenue shall start if there has been a substantial performance of the franchise agreement. So after this, the next question is if the initial franchise fee, so IFF in this diagram, is payable for an extended period. If the IFF is payable immediately in cash, then the earned franchise fee or EFF here in this diagram is the whole cash collection. And there is no more unearned franchise fee. So that's why it's non-payable. Now, if the IFF is payable for an extended period of time, next question is, what is the reasonableness of collection of the notes receivable? Is it reasonably assured, not reasonably assured, or uncertain? So when we say reasonably assured, it's more likely than not it will be collected. So because of this, the proper accounting method to be used is the accrual method. So basically, we will recognize everything already. So now, if the collection is not reasonably assured, then we will apply the installment or the gross profit method. So I'm not sure if you already learned about the installment sales method, but the method is similar. So then lastly is collection. If the collection of the note receivable is uncertain, we shall follow the cost recovery method. Okay. So more on the method. So in here, so that we can understand more the differences between the methods, I prepared this table. So we have the approval method, the installment method, and the cost recovery method. So first consideration is, as I mentioned earlier, what is the assurance of the note receivable collection? For approval, it's reasonably assured. For installment method, it is not reasonably assured. And for cost recovery, it's uncertain. For the earned initial franchise fee, under the approval method, the total cash collected and the note receivable, as promised by the franchisee, will be considered already as revenue. Then, let me just go directly to the direct cost. For the direct cost, recognized as part of OPEX, under the approval method, everything is also recognized. Okay. Now, under the installment or gross profit method, in short, it is not recognized in totality. Why? Because it is the amount of franchise fee and the amount of direct cost to be recognized is will be given by this formula: total cash collected times GPR percentage, wherein the gross profit rate percent is equal to the total initial franchise fee minus direct cost. So basically, that's the gross profit divided by the total initial franchise fee. So in layman's term, ang sinasabi ng formula nito is we should recognize the revenue and the direct cost as we receive the cash. No? Because again, this method is applicable if there's no 100% assurance that the collection will be made. Now for the cost recovery method, so for the initial franchise fee, only the total cash collected will be recognized as part of revenue, regardless of there is note receivable. Meaning, in other words, the note receivable will not be part of the revenue. However, for the direct cost, all of the direct costs will be recognized already. Okay. Now let me proceed with the indirect cost. For indirect cost, it's the same treatment under each method. So all indirect costs that occur on a regular basis, whether it is for initial franchise fee or continuing franchise fee, are expensed in the period that they are incurred. Okay, so OPEX, diretso na siya sa OPEX. Number 5, same treatment as well for earned interest income of note receivable. So for the note receivable, sometimes the franchisee will offer us a promissory note with an interest-bearing note, and sometimes they will offer us the franchisee will offer a non-interest-bearing note. So the key point here is that we we should recognize the earned interest income on the note receivable under regardless of the method for the revenue recognition. So as reference for the interest-bearing note, the interest income is equal to the face value of the note times the interest rate. For non-interest-bearing note, that is the present value of the note times the interest rate. Okay, so same treatment for all. Then lastly, I just included your class so that we have more appreciation. What is the tendency of the net income under each method? So under the accrual, it tends to show us the highest net income result. Then for the cost recovery, it shows the least. Then the middle is the installment method. Okay, so if you have questions, please raise them because we will now proceed with the.
Can you go to the case? Yeah.
Case. So let us use this case to illustrate how the journal entries and the calculation of the net income. So in this case, on May 31, Mr. Dong entered into a franchise agreement with Miss Alice, owner of the restaurant McKinney Rogers, a popular brand in Bamban, Pampanga. So the agreement provides for an initial franchise fee of 1.2 million, which is payable as follows: 400 pesos cash, so this is the down payment already received. Then the remaining to be paid upon signing of the contract, and the balance, which is 800,000 pesos in 5 equal annual installments. So that's 200 pesos for every installment, every December 31 starting 2024. So next is Mr. Dong signs a non-interest bearing note for the 800,000 balance. So the credit